Hello, everybody. Welcome to this webinar that is brought to you by Bursa Malaysia and managed by LifeChamp. Our webinar title is Trading with Oscillators and Indicators. Now, if you are into technical analysis, we must learn what are oscillators and also indicators, so we can use these two tools to help us in finding a good entry and exit point. So today we are very honored to have invited one of the master principal of the MSTA and also CFTe program, Tuan Haji Zainal, to come to this webinar to share with you how we can use oscillators and indicators effectively to find good entry and good exit. Okay, so my name is Shen Chu. I'm the moderator for this webinar. So as usual, disclaimer, whatever we share on this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any companies or any counters. So if you decide to make any investment or trading decisions as a result of this webinar, you're 100% responsible for all your own investment risks. So that's our disclaimer. So allow me to briefly introduce our speaker. He is often invited to come to Bursa webinar to conduct trading classes. So he's none other than Haji Zainal Arifin. Okay, so Tuan Haji Zainal is a certified financial analyst, also a certified financial technician. If you can see as his credential and qualification, you see that he is very well qualified in the technical analysis space. He is a full member of the International Federation of Technical Analysts, IFTA. He is also a full member of the United Kingdom Society of Technical Analysts, UKSTA. He is also a full member of the Malaysian Association of Technical Analysts, MATA. He is a senior vice president of Inter-Pacific Securities, Sdn Bhd, Pengerusi Koperasi Remaja Bumiputra Berhad, mantan timbalan president Persatuan Remaja Bumiputra Pribumi, former principal consultant for MSTA program. So this is his credential and qualification. Isn't that amazing? So without further ado, let me hand over the session to you, Tuan Haji.
Okay, good afternoon. Yes. Thank you, Shen. Thank you, Shen.
All right, cool. So let me stop sharing my slide and you may go ahead.
Okay. All right. Thank you, Shen. Thank you. Yes, thank you, Shen, for moderator. First of all, thank you very much to Bursa Malaysia and also this LifeChamp to have this kind of session and give me the opportunity to share some knowledge about technical analysis. That is what we call is my forte and something that I love so much about the technical analysis. Okay, Assalamualaikum warahmatullahi wabarakatuh and very good evening to all of you. Rabbi shrah li sadri wa yassir li amri wahlul 'uqdatam min lisani yafqahu qawli. Okay, ladies and gentlemen. Okay, let me share my screen first. All right. Okay. All right. Okay.
Fantastic.
Yeah. Okay. You can see my screen. Yes. All right. There's
yes,
me.
Perfect.
Okay. Of course. Actually, you see me outside. I'm more handsome than the picture, lah. Okay, basically.
Yeah, I would very much agree with that.
Okay, this is true. Yeah, right. So I hope all of you are healthy. You see now at the moment there is a new variant, and the new variant is Omicron also now is arrived in Malaysia already. There's one case in Ipoh. So my advice is that to all of you, to all of us, not all of you, all of us, is that stay at home, try to avoid the crowded area or enclosed area, and also that we pray to God, we pray to Allah that we all are safe from being affected or being infected by this COVID-19. Of course, there's a lot of people also. There's also scientists are saying that this new variant is even though it can can travel fast, but then it is not as fatal as the original. But whatever it is still a COVID-19. Okay, so I believe the Malaysian have almost more than 90% already have the vaccine, but still we have to be careful. All right, ladies and gentlemen. Okay, yes, this at the moment actually I'm still consultant or principal for the MSTA program. And the last exam, I have, Alhamdulillah, I get 100% pass. So all my students pass the exam. So Alhamdulillah. So I'm doing it. I'm still doing the MSTA program. The next exam will be in April 2022. So if you are interested in the technical analysis, I advise you to take the MSTA program or take the exam so you get yourself certified. Not only certified, that you also will be well versed with the technical analysis and you know how to use all of the indicators. Okay, all right. So that is for the introduction. Okay, today's topic is about oscillators. All right. Now let's say what is this? What picture is this? You see? Okay. Actually, this is a cockpit. Is an airplane cockpit. So if you have been to the airplane cockpit, actually there is glass there. Yes, there's glass. There's glass there. But then, can you see anything there? You can see nothing. You see, because you're top, let's say 10,000 level or 3,000 level on the sky. There's nothing you can see. You see, so you can yes, you can see the sky. You can see the you are above the cloud. Yeah, nothing else you can see. It's just not even a cloud. Is it? Because cloud is way below you. Is it? So how are they going to travel, or how the pilot know where they are going? So they only know based on all of these indicators. So indicators, which you can see all the button and everything, all the screen they have there. They can see all of these indicators. Indicator, which means that they indicate the height of the plane, the speed of the plane, see, and all of that. You see. So in the technical analysis or in the trading also, that sometimes we are lost in the sense that, you see, we don't know where's our direction. So we need the indicators so that we know, oh, this is our direction and this is where the market will go. Okay. Right. So the first thing first. Okay. Now this indicator and the oscillators. All right. Okay. Right. So today's topic is about the indicator and the oscillators. Okay. So what is indicator oscillators in terms of the technical analysis? A technical indicator is a series of data points that are derived by applying a formula to the price data of system. This is definition. Okay. So this definition. But basically the indicator, which means they're giving you some hint or indicate of certain price or movement of the price and all that. All they're talking about, either it is a trend or it is a overbought or oversold. Okay. When you talk about price data, this is include what we call is open, high, low, close over a period of time. Meaning what? Meaning is that it can be short term, it can be long term, it can be a very short term. For example, 5 minutes or 10 minutes or 30 minutes or 1 hour, or 1 week or 1 month. All of this, so we need open, high, low, close. And because some indicator they need all of this, but not all. Some indicators they just use closing price. Some indicator they use open, high, low, close. Some indicator they use only high or close. Just so many, right? Because different what you are looking for will need a different indicator. Okay, so some indicators use closing price. Yes, then there's some of them they also incorporate the volume also. So they use also the volume. The price data is entered into the formula and the data point is produced. Okay, so this is what we call what we call introduction, or we call it introduction or the definition. Okay, so next question. Okay, why we need to use indicator? Can't I use only the price or the price action? Yes, you can use the price action, but then sometimes you are not very sure. Is it uptrend or is it downtrend or is it overbought or is it oversold? So you need another thing or another indicator or another instrument or another tools for you to determine whether it is uptrend or it's a downtrend or it is overbought or it's oversold. Because basically in the market, actually it's quite easy if you understand. In the market, whatever you use, only you're looking for what? One is the trend, second is overbought and oversold. That's all. You can use any kind of indicators. You can use whatever it is. Usually it falls into this category. Okay, so in here they said to measure the strength and direction of the underlying price action. What does it mean? It means that, which means that you're talking about the trend and also the support and the resistance. So that's what we're talking about, the measure, the strength and direction. What is strength? Strength is support and resistance. The direction is the trend. Okay. Second is to alert, to confirm, and to predict. What does it mean? It means that, you see, by using this indicator, you can use this indicator as a signal of entry and signal of exit. So that is what it means. Okay. Any analysis indicator should be taken with the price action in mind. Okay. Now, even though this indicator or oscillators, that they give you the signal, but the most important is the price action. A lot of new people or a new student in the technical analysis, they miss this point, you see, because the most important in the technical analysis is price action. Only then that others will come in, moving average, these indicators and all that. Okay. So there are two types of indicators. One is leading indicators. Second is lagging indicators. Of course, both of they have their own advantages and disadvantages. Yeah. Not necessarily lagging is good. Neither leading is good. It doesn't mean that you say, oh, leading indicator is good because it will give me a earlier signal. Not necessary, because leading indicator always mislead. Okay? Lagging indicator is slow, so you need to combine it together and make choose the one that is suitable for your trading style. Okay. So what is leading indicator? Okay. The leading indicator are designed to lead the price movement. So which means that they'll tell you ahead, or they give you ahead what is going to happen to the market. Okay. So what's an example? The most common one is the CCI, or the Commodity Channel Index. The Commodity Channel Index previously was used in the commodity trading, but now a lot of people use, or a lot of traders or a lot of technical analysts use it in the even equity or even in the bond market and all that. Okay. The next one is momentum. The relative strength index, it can be lagging, it can be leading. Stochastic also the same. It can be leading, it can be lagging. And the William percentage R also is almost the same, which can be leading and can be lagging. Okay, leading indicator. Okay, what is the advantage of the leading indicator? One is that early signal for entry and exit. You see, it generates more signal and allow more opportunities to trade, especially during the good market or during the what we call bull market. So they give you more signal and have more opportunity for you to trade. And also they give you early signal so that you can act, or you can give you a warning against a potential strength of the market or weakness. What does it mean? It means that, which means that they give you a warning of the reversal, market reversal, which means that if market is uptrend, they give you a early warning that market is going to turn or going to downtrend. If the market is downtrend, they give you early signal or early warning that the market is going to go up. Basically, it's not really that. It's not really that we are talking about whether the actual term, you see, the actual term or what we call the actual is like this. The indicator will tell you the end of trend. That is the end. It's not really beginning. Sometimes, most of the time, they tell you the end of trend. So which means that it's going to let's say, for example, the market is uptrend. You see, when they give you a signal, you see this that the uptrend is over. That is what it means. Okay. Next one. Okay, so best used in the trading market, or which means that in the trading market or in the non-trending, and this indicator can be used in the trending market, but usually with a major trend, not against it. So which means that you use it using a major trend. Later, I'll show you some of the example and how to use these indicators. And the indicator, there's a lot of indicators, but I only show you only the some major indicators or some of the most important one. All right. Leading indicator. Yeah. In a market that is trending up, this is how to use it. The leading indicator can help identify oversold condition for buying position. So which means that the indicator will indicate or will tell you that at the moment, at that particular time, the price is oversold. And this is opportunity for you to enter the market. But don't forget, in the uptrend market, see, uptrending. That's the first thing. The first thing, uptrend, and then they tell you whether you can, which level that you can enter. Okay. In a market that is trending down, the leading indicator can help identify overbought situation for selling opportunities. Okay. So these are the disadvantages of the leading indicator. The advantage is that more signal and earlier signal mean that the chances of false signal and whipsaw increase. I think as I said earlier, which means that they are leading, they give you always a misleading, or which means that they don't really give you the true picture. Second, the false signal will increase the potential for losses. And the third, the whipsaw can generate commissions that can eat away profit and test trading stamina. This happens only when the market is non-trending or the market is sideways. So it will always give you a lot of false signal if you use the leading indicator. Okay. So now, next one. So we go on the lagging indicator. Okay. Okay. Lagging indicator is follow the price action and are commonly referred to as a trend following indicator. Okay. So basically, that's very, very, very closely towards the trend following indicator. Okay. So it works best when market or securities develop a strong trend. So which when the market is uptrend and is downtrend, this lagging indicator works very well. Okay. They are designed to get traders and keep them in as long as the trend is intact. Not effective in trading or sideways market. Okay, what does it mean? It means this way: when the market is up, or market is the uptrend, see that this lagging indicator is very good. So which means that it will tell you whether the market is going to turn or not. So as long as the leader, this lagging indicator is still show that it's just going up, you just maintain your position and you just hold your position until it gives you a signal to get out from the market or give a signal that the trend is over. But it is not effective in the trading or in the sideways or non-trending market. What of it? The most popular one usually is moving averages. That is also indicators, and also MACD. MACD or moving average cumulative decline also is actually is derived from the moving average. So the advantages. What is the advantage of the lagging indicator? Ability to catch a move and remain in move. So that is the ability. So when you understand and you know what's the difference between lagging indicator and leading indicator, so that you can choose which one that you can use in certain kind of market. If market is in the uptrend mode or in uptrend, you can use a lagging indicator. When the market is sideways, so you can use a leading indicator. Okay. Yeah. It can be enormously profitable and easy to use. Yes, lagging indicator is very profitable, and in fact, a lot of traders, a lot of successful traders are usually using lagging indicators. The longer the trend, the fewer the signal and less trading involved. So which means that it less cost to you. You just go in and out, buy and sell, which means that it involve a lot of cost or a lot of commissions. Especially now the stamp duty is already increased to 1.1 increase 50% stamp duty. So it can be now the cost of transaction cost, the stamp duty can be higher even with the brokerage. The brokerage can be cheaper than the stamp duty if you buy a huge amount of shares. For example, let's say previously there is no capping. Last time previously as they are capping for 200 ringgit for the stamp duty, but now there's no capping. So which means that you buy more than the 200,000 worth of stocks, and then you have to pay more for the stamp duty. Okay, disadvantage. The lagging indicator, the main disadvantage of lagging indicator is that when the sideways or non-trending market, so you cannot use the indicator, this lagging indicator. Why? Because there will be a lot of whipsaw and there will be a lot of a fall signal for this lagging indicator, or what we call it whipsaw. And Another advantage of leading indicator that they are late signal, late entry and exit point, which means it can skew the RR ratio or reward to risk ratio, which means that it will give you only the signal perhaps 5 to 10% from the highest or from the lowest, but it is safer using this lagging indicator. So it depends. It's still back to depend what type of investor or traders you are. Are you an aggressive trader or are you a passive investor? So if you're aggressive, perhaps you might know how to use, or you have to learn or to know when you want to use this lagging indicator. How to use the indicator? Basically, there are, as I said earlier, there's a lot of indicators, you see, but how to use it basically is almost the same. It's almost the same. There are only two things. One is crossover. Second is a divergence. See? What I'm sharing with you today basically is a part of the syllabus of the MSTA, Member Society or Diploma in the Technical Analysis, so that it is easier for you to understand the usage of indicators and how to use it. So whatever indicator also basically is almost the same. So one is crossover, second is divergence. Yeah. This is divergence. What does it mean of divergence? Divergence here means that the price action creating a new high. For example, you can see that the price action is creating a new high, which means that this high is higher than this high. So which means there is a higher high. We call it higher high. But the indicator, or in this case is RSI, is creating a new low. Oh, sorry, a lower high. See? You see, this is one is going up. The price action is going up. The RSI is going down. So why? Why is it? It shows that the speed or what we call is that the rising here, which means is weakening. So that is the purpose of this indicator. They will tell you that even though the price is still rising, but it is start to slow down. So which means that the movement is going to end very soon. The upward movement in this price action are going to end very soon. You see. So it's true enough. We can see that after that, you see there is a crossover. This is what I call crossover. The crossover here means that either it is using a overbought, oversold, or it's a 50 line or 0 line. So in this case, the signal that give you is that when the RSI cross from the top or from the above to below 70 line. This is the sell signal. As you can see that in here, in this example, that the indicator or this indicator give you a signal much earlier from the very good or very much earlier from the price action itself. The first is that divergence. The second is the crossover. Once is crossover here, you can see that after that the price, even though there is a price going up, but then after that all the price all the way down. So next one. The next one is that about the buying signal. Where's the buying signal? When the price move from the bottom and cross the 30 line. That is where the signal. It's not the signal whereby that, yes, of course, we can say that above 70 is a overbought. Below 30 is oversold. Yes, you can read, or you can read all other articles or in the internet or whatever. That's what they always say. Above 70 and below 30. But the signal is not the signal. The signal is that one they start to turn crossover or divergent. So that is the actual signal. All right. Okay. So next one, that is the indicator. So next one is the oscillator. So what's the difference between oscillators and the indicator? Basically, the usage is almost the same. The only thing is that we categorize it. One is oscillator because it's oscillate. Another one is the indicators. So an oscillator is an indicator that fluctuates above and below a center line or between a set level as its value change over time. That's the meaning of oscillators. We call oscillators. Okay. Oscillator can remain at extreme level, which means overbought or oversold for extended period, but they cannot trend for a sustained period. So which means that this oscillator, it can be at the overbought or at the oversold for some time, for extended period of time. Okay. So oscillators, there are two types of oscillators, or we categorize it two type or two style or two type. One is centered oscillators. Another one is banded oscillators. Okay. What is centered oscillators? The centered oscillators is that it fluctuates above and below a center line, point, or line. Okay. Either it's 50 or it is 0. Okay. So it is good to identify the strength or weakness or direction of momentum behind the security move. Okay. So bullish when the oscillator trading above the center line, and bearish when the oscillator trading below the center line. Okay. How is it? Okay, we'll show you the example later. Another, for example, okay, one of the popular oscillators is a moving MACD. MACD is unique is that it has a lagging element as well as a leading element. Okay, moving average usually is lagging, and it will be classified as a trend following or lagging element. However, by taking the differences in the moving average, MACD incorporate the aspect of the momentum of the leading elements. Okay, I'm not going to teach you how to calculate the MACD. I think you can Google it and whatever. But today, I'm just to share with all of you is that how to use the MACD. Okay. By measuring the rate of change, MACD become a leading indicator, but still with a bit of lag, which means that even though it's leading, but it's still lagging. Okay. With the integration of both moving averages and rate of change, MACD has forked a unique spot among oscillators as both a lagging and leading indicator. I am a big fan of the MACD. I use MACD a lot. So this is an example of MACD. There are two types of MACD here. One is the histogram, the other one is MACD. Okay. This is a price action. Is at the top level is the LBM KLCI. This is the LBM KLCI. At the bottom is the MACD. Okay. If you notice that, how to read this MACD? Okay. The center line is a 0 line. Whenever the price or the MACD move above the 0, which means that we are saying that it is a market is uptrend. If the price below 0, so we can say that it is a downtrend. Okay. This is crossover when the yellow line cross the blue line. This is the buy signal, and we can also use, or we can see also at the, you look also at the histogram, whereby the histogram when it's green, it is a buy signal, or it is a bullish, or when it's red, it is a bearish. And if you notice that when the price is non-trending, you can see there's a lot of fluctuation here. You see there's no fluctuation here from December to March. You can see there's a lot of fluctuation, which means that the MACD is moving, fluctuate or oscillate between the 0 line. So this is where I just said just now, whereby when the market is non-trending, usually it gives you a lot of fall signal. Okay, so how to read this banded oscillators, for example? How to read? Okay, how to read? One, if RSI is used 70 and 30, stochastic is 80 and 20. So 70 and 30 for the RSI, and stochastic is 80 and 20. So then centered oscillators, it best suited for analyzing the direction of price momentum, and the banded is the best suited for identifying overbought and oversold level. So this is why the reason that you need to know whether that oscillator is a centered oscillators or banded oscillator. Okay. Now, the next one, we go to the stochastic. Okay. Stochastic oscillators is a momentum indicator that shows the location of the close relative to the high-low range over a set number of periods. So we take this stochastic will take the high and the low. It follows the speed or the momentum of price. As a rule, the momentum changes direction before the price. Usually, stochastic can become a leading indicator. As such, bullish and bearish divergence in stochastic oscillators can be used to foreshadow reversal. So, which means that it is we have to look closely for any indicator or any divergence in the stochastic oscillator. Yeah. So what you use, how to use, or what is usage of the stochastic indicators or oscillators? One is that to identify bull and bear. Second is that to identify overbought and oversold, which means that we set 80 to 20, or some people or some of the traders, they use when the market is what we call a market is uptrend or very uptrend, they use it 30 and 70, but usually the default is 20 and 80. And to identify the divergence and the support resistance line at 50. What does it mean? It means that if it's above 50, it is a bullish. It's below 50, it is a bearish. That's what it means, the support and resistance. Okay. Okay, this is stochastic. This is stochastic. As you can see, that the stochastic will tell you where is the peak and the trough of the price action. When the price move down, as you can see that the price come down and it break below the 20 and it reverse. And it is a confluence with the trough of the price action. And here, you can see here also, it is confluence with the peak of the price action. It goes up and it gives you a signal of selling signal here, and the price goes down. Okay, is there any divergence here? Not really. This one divergence. No divergence. Okay. And they give you a buy signal. This is a buy signal. Buy signal. Okay. This is a buy signal for this stochastic. All right. Now, you see, even though that we use these indicators, but please don't rely just purely on the indicators, because we have to look at the first thing that to look is, what is it? Is it the price action first? The price action. What do you mean the price action? So which means whether it's uptrend or it's downtrend. That is most important. You see. Okay, that's the most important. The most important is the price action. And then only you look at the indicators. Okay. Next one. Next one is this one. Okay. Okay. What's the difference between these two things? These two. Okay. The difference between these two is that you can, this one we call it, we draw at the bottom. You draw at the bottom, so which means you can draw at the bottom of the chart, or this one we call it overlay, which means that you overlay on the chart. Is it the same or is different? The answer is the same. It's the same. No different. It's no different then, because they use a different scale. Usually they use a left scale for the this stochastic, and the price action on the right. So you can see that it's almost the same. It's the same. Basically, these two things are the same. The only thing is that this is you draw it at the bottom, and this one is overlay. Usually I like to draw it overlay, so it's easier for me to see. But sometimes it can be look very messy. So it depends. It's up to your liking which way or which one you like. Either use overlay or use it at the bottom. Okay. Next one, RSI. RSI is very popular. It's very popular. It's invented in 1978. It came to Malaysia in 1985. I learned about RSI in 1985. There was a seminar in Singapore. They talk about the RSI by Dr. Wallace Elders. And I learned from somebody went to that seminar. So I learned this RSI in 1985. So that was a long time ago. So it's very interesting. But now I use more stochastic than RSI. But anyway, RSI is one of the very popular indicator. and also it is a very good. Okay? Because RSI basically is a momentum. It's a momentum indicator that is solve the problem. You see? RSI usually previously there's a momentum indicator. The problem of momentum indicator is that there is not banded. So which means that it can, when it goes up, it can go very high. When it come down, it can go very low. So there is no band or there is no limit of that. So by using the RSI, using the formula, so that the RSI will be band between 0 to 100. So it's easier for us to draw and easy for us to draw previously, because in 1985, when I draw this all of this technical analysis, or we draw this all the chart, or we draw by manual. So it's by manual. There's no computer, there's no program at that particular time. The first program, or the first computer, or the what we call is chart that is using the computer that I learned, that come to me in my hand, is only in 1990. So I start to use of this is 1990. So it was long time ago. There was a Metastock. I still remember Metastock version 1.6. Okay, so but still we have to key in the data manually. Okay, so RSI strength index, momentum indicator, oscillators that measure the speed and change of price involvement. So RSI, we oscillate between 0 to 100, and we put a benchmark, or you put we draw a line. 70 is overbought, 30 is oversold. So what signal the RSI give? They give you, one is divergence, failure swing, and center line crossover. So these three things. RSI can also be used to identify the general trend. Okay, so sometimes I use RSI to determine the trend. Okay, this is example. Okay. As you can see, above 70 is overbought, below 30 is oversold. So you can see that this is overbought. This is the first line here. This is overbought, and this is oversold. So where is the signal? The signal, once it goes, come in again, come in inside, and this is the signal. So you can see that it's oversold. You can say overbought, and this is oversold. The green line is oversold. The red line is overbought. Red vertical line. I'm talking about the red vertical line and the red green line. This is divergence. RSI is very good at divergence. Very powerful. One of the powerful indicator for divergence is RSI. As we can see, this is creating a higher high, which means the price action create a higher high, but the RSI not creating a higher high. So which means that the high of the second high is in RSI is lower at the previous high. So this is what we call a bearish divergence. What did it tell you? It will tell you that the movement or the high of this level is weak, which means that it's going to come down very soon. So what are we going to do? Once we see the divergence, we sell straight away, we get off the market? No. It just gives you a warning that you have to look at the confirmed signal. Where is the confirmed signal? The confirmed signal when the RSI fall below or drop below the 70 line. So you can, if you want to use the RSI or you want to use some other indicator. But what RSI tell you when there is a divergence is that they tell you is that the movement or the uptrend is going to end very soon. That's what it means. Yeah. So RSI, they use the closing price. So you can see that the pink line show the closing price. There's a pink line, so it's just using all the closing price. Okay. The next one is that the bearish or bullish divergence. Bullish divergence here is that is the price action creating a lower low or a lower trough. We call it lower low or lower trough. But the the RSI are making a higher low. If you notice here, so which means that look here, the RSI, this price action making a lower low, but the RSI making a higher low. So what it tell you? It tell you that this is the going down, or the downtrend is going to end very soon. That's what it tell you. Okay. So where we take action? We take action once the price or when the RSI cross the 50. See how is the okay, I have a oh yes, okay. I explain this one. All right, this one. Next one. So I don't have to go for the so this one. Okay, so bullish failure swing. Okay. Bullish failure swing. One is that when it's below 30 to become oversold. Okay, below 30 is become oversold, and bounce back above 40. Yeah, bounce back above 30, and pull back, hold above 30. See, and break out above prior high. So this is what we call a bullish failure swing. What does it mean? It means that it gives you the signal, but it fail signal. That's why we call it failure swing. And you can notice also that the price is sideways. So RSI is not good, or it is not very useful in the sideways market. This is bearish failure swing. Bearish failure swing, whereby when this is overbought, it gets overbought, it come down and it goes up again. It's to come back below 70, and its support is here. Break the support here, so which means that it will be the support. That is where it should. Okay, another one is okay, trend indicator. This one also, another one is a trend indicator. This is how to use the RSI, because RSI is very popular. See, I repeat again. One is the divergence. Second is failure swing. The third is the whether it is bullish or bearish. So usually we use between 40 and 50. We make a band like this, 40 and 50 as a act of support. Above 50 is a bullish, below 50 is a bearish. For example, you look at here, it's back. Okay, you can see this is 50 line. When the RSI drop below 50, this is a bearish. You can see that's all the way is a bearish, and it is bullish here, then turn down again bearish. Still is still bearish. So you can see that. You can see that inside the RSI. RSI will tell you whether it's just bullish or bearish. In here, we can also the same. This is a bearish. It's all the way bearish, bearish, very bearish, and they start when it start to move up above the 50 line. Then you can see that the price is a bullish. So which means that above 50 is a bullish, below 50 is a bearish. There are some there's a lot of auto traders. They use the RSI also a signal line, which means that they use the 50 as signal line. They only enter the market when the price or when the RSI move from below 50 to above 50, and they sell once the price or the RSI fall from above 50 to below 50. Also, it can be used. This is okay. Just now is what we call this bull range, and this is a bear range. So what's the difference between bull range and the bear range? The purpose is that to determine whether there is a change in trend. Is it a change in trend or not? Okay, you can notice like this. Okay, this is the price is rising, and then no, not much here. You can see this is very much. This is much more clearer. The RSI below 50. What does it mean? It means that it is a bearish. Okay, bearish. Okay. And one is break the level or break the resistance zone is 50 and 60. It above 60. So this one indicate that the price or the price action is now bullish, or the market is turned bullish. That is why I call a breakout here, and the market is bullish. So this is the usage of this RSI. In here also same thing. This is this line 40 and 50 as support level. As you can see, is support level, and then even though it's a drop, so you can use that this as using also as a support level or as a trend identification. Line 50 as a support line, you can see also it's the same. It's whereby where that they show you there is an uptrend, and one is below, break below the 50 line, it is a downtrend. They start to show that it's a downtrend already. Next one, how to combine of these indicators and oscillators. This is very important. See, when you trading, when you do the trading, this is very important. Why? Because this kind of combination will make you become a better trader because you can understand the whole market. Because in the market, what you want to see, the first thing is that you want to look at the trend. Is it uptrend or is it downtrend? The second one is that is it overbought or oversold? And also, how is the volatility of the market? So these three things that you need to know. Once we know all of these three things, only then we can make a better decision whether want to enter or to exit the market. Okay. So the first thing, what indicator or oscillators that we can use to determine the trend? Okay, one of the good one of this I always use is the MACD. So I use MACD to determine the trend, whether it's uptrend or downtrend. Okay. And the direction. What does it mean? What's the difference between the trend and direction? Trend is more towards a long term. Direction is more towards a short term. Okay. For example, let's say I draw. Okay, like this. Let's say the market move like this. This is a trend. Okay, and direction. This is what we call a direction. This is what we call a direction. Okay, that's what it means. Okay, so direction, I use the stochastic, and the volatility, we use a Bollinger Band. Okay, Bollinger Band, I give a talk. I give a talk about Bollinger Band. I think about a couple of weeks ago. You can find the video. It's free also. This sponsored also by the Live Jam and this Bursa Malaysia. I think it's also available in the YouTube. Okay. This is one combination of the indicator. Of course, if you look at it, you don't understand. It look very messy, but actually, it's tell you, or just one glance, you can see the whole picture of the market direction. The first thing is that we look at it is that the red line here is a Bollinger Band. See, so based on this, we can see that whether Bollinger Band, whether it's expand or it is a contraction or there is expansion, and based on this, also using the Bollinger Band, you can see whether it is an uptrend or it's a downtrend. And the next one is this line or this line. This is a MACD. You can see that whether MACD is a uptrend or is a downtrend, or whether it is a below 20, below 50, or below the zero line or not. And the next one is that the oscillator or the stochastic. The stochastic will tell you the peak and trough of the market. Okay, I repeat again. See, this is very important. I repeat again. Okay, one, that you want to see the volatility, that we look at the Bollinger Band. So whether it is overextended or it is a contraction or it is as it expand or not. So is it is contraction or is expansion? So it's expansion, so we know that when it's expand, which means there is a volatility. Okay, and then we want to know the trend. How do you know the trend? We look at the MACD, whether it is a uptrend or it is downtrend, and we want to know also is the peak and trough. So we look at the oscillator, or we look at the stochastic to know or to determine whether peak and trough. So why you need to know the peak and trough? The purpose is that for you, for the entry, where that you want to enter or exit the market. Remember that when I tell you that it is sequence. The sequence is what? Is that the first sequence is the trend. The second is the direction, see, and the third one is the volatility. Why? The trend will determine whether it's up or down, but the volatility will determine whether the trend can sustain or not, or whether it's strong or not strong. If it's uptrend and it's the volatility is strong, so which means that the uptrend will continue. Yes, now we know the uptrend will continue. The next question is that where to enter? See, then we use the stochastic, is that where to enter or where to exit, whether in the downtrend or in the uptrend. Okay, so it is very useful if you need to practice. It is very simple. Actually, the indicators is quite simple, but you need to practice in order for you to use it, because it's just a 1 hour or 2 hours you listen to me from me the 1 or 2 hours, actually it's not enough. But then if you repeat it again and you practice, and then I believe that you can become a very good trader and make money in the stock market or in the other market. Thank you. Yeah. So do you have any question? Back to you, Shane.
All right, so if you have any questions for our speaker today, Tuan Haji Zainal, you may write in the Q&A box, not the chat box, right? The Q&A box, and then we'll address that accordingly. I think today we have learned a great deal about indicators and oscillators, different type of indicators and oscillators for different use. So we have learned a lot. So yes, questions number 1 is from Edwin. Besides Fibonacci, could you list like what are the top 10 leading indicators?
Oh wow, actually okay, basically, you see, in the indicators, there are so many indicators. There are a lot of indicators. Let's say, for example, okay, let's say let me share your screen. Let me share the screen and I show you how many indicators are there.
Yeah.
This is the this is a trading view. See this trading view. All of these are the indicators and strategies. Some of these strategies are indicators. You see, even the built-in indicators, there are so many indicators here. You can see they are huge from A to Z. There are so many indicators. So the question is that it's not the what indicator that you use. The first thing that you ask yourself is that, see, what I want to know or what I want to see. Okay. So usually that we categorize it. One is that trend. Second is the trend, volatility, and also the support and resistance or peak and trough. So you can use a lot of other indicators. For example, like in this case, for example, if you look at the chart, here, this is my template. I use this. When I use my trading, I use this. One is that this is moving average. For me, it's easier for me to see, even though it is the same like this MACD. You see, but it's easier for me to see. Okay, MACD. This is 20 days, and the green line or the yellow line is 5 days, and the bottom here is the volume indicator, stochastic, and MACD. And I use another one that is not here, not here. Yeah, but this thing is enough already. It's enough already for us to see. So you ask me to give me what is the other indicators, because there are so many. There are so many. But usually that is the one that is we use actually is a CCI. CCI is a leading indicator. Or you can use RSI, you can use stochastic. I personally use stochastic and MACD. Okay. Next question.
Okay, Tuan. So what's the difference between RSI and stochastic RSI?
Okay, RSI and the stochastic, the difference is that the one is that the formula is different, and the second is the usage. Because the stochastic, even though the stochastic and RSI look very similar, but the formula is different, and also the usage is different. The RSI usually that we determine of the direction or the trend of the market, whether it's uptrend or it is a downtrend, or the divergence. But the stochastic I always use to determine the overbought and the oversold for the particular stocks. And usually the advantage of the stochastic is that it's always leading compared to the RSI. RSI is only leading if there is a divergence. If there's no divergence, usually there's not leading, and it can be misleading also, because RSI is very fast. When the market turn, you see, let's say for example the market from is downtrend, and it start to move up, the RSI can hit 70 very fast, so it gives you a false signal. So that's why I said, that's why the most important you have to look at is the trend first, whether it's uptrend or downtrend. Only then we look at the RSI or the stochastic. So it depends on the how you use all of these indicators.
Okay. So Vijen would like to ask, are there any other indicators that can be used to identify divergence?
Most of the indicators you can use as divergence. Even the momentum also is the same thing also, is a divergence. So basically, a lot of indicators is in the base of these indicators usually are either is a moving average or momentum. Then from there, they develop or they create a lot of other things, other indicators. So any kind of momentum indicators, that category in terms of momentum indicators, you can use it as a divergence. You don't need to use or you don't need to learn about all kind of indicators because basically all of them are the same. The only thing, what do you need? What you want to know? What you want to know or where that is what we call what actually that you need to know. Only then you look what is the tools that you need to know. For example, like this. Okay, let's say now you see you want to cut something. Okay, you want to cut something. So you need a knife. See, so the first thing you got to ask what you want to cut. Okay, let's say now you have to cut a log. You see, you have to use a chainsaw, or you can use you have to use, for example, like an axe. Okay, see, but then you cannot use a blade, a razor blade, to cut the log. You see, or you say you want to shave, you cannot use the axe, or maybe I don't know whether you use axe to shave, or you know. You see, is it there is there you need to know what you want to what you're looking for. You see, only then you look at what is the suitable indicator for that purpose. Yeah, the problem a lot of new people or the new one who just learn about technical analysis, they tend to use the indicator for the wrong purpose, so they'll give you a false signal. That's a problem.
Okay, I see. So Tuan, how do we use indicator and oscillator in intraday trading?
Okay, good question. Okay, in intraday trading is slightly different. It's slightly different, even though it's almost the same, but then the time frame is much shorter and slightly different. The first thing that you need to, but the what we call the sequence is still the same. The sequence or the what we call which means that what you use first is still the same. The first thing is that we have to use or we have to look at is the trend first, the trend. And after the trend, only then we look at the what we're looking for. We look at the overbought or oversold of that particular short term. Let's see whether you can see here or not. And let me see whether I can share or I can see here. For example, let's see here. Let's see now this. Okay, no, this is no good. Let's see now. It's a bit slow. It's nice. Okay. Usually we call it multiple time frame. We call it multiple time frame. The first thing you need to know, or when we use or we want to trade for the intraday, see? The first thing is that it is uptrend. That's the first thing. It's uptrend, or whether it's uptrend or it is band. Band which means that range. What range they are talking about? See, you need to determine the range first. See, so usually we look at the daily, or we look at weekly first. We look at weekly and daily. For example, let's say now in here that we know that this is the band or the trend here from for the whole week. This is the range. The range here, for example, is from the 5605 to the this level of 5.35. Okay, first one. Second, that you have to look at the shorter time frame. Let's say, for example, now we have to look at 5 minutes. Okay, 5 minutes. So you didn't know the range already. You didn't know the range. Okay. And so you determine where for you to buy and to sell. So we use, usually that I use is a stochastic. So whenever the stochastic, you see, hit below the 20 line, that is where the buy signal. Of course, don't try it before you try on the paper trade. Practice is because the short term you need to be precision. You need to be precision. But the theory or the way of doing it, that's it. The first thing you have to look at is the range or the uptrend, the range, and also the signal. So what we use the signal? We use the stochastic to give you a signal. Once it's dropped below that level, that is where is the buy signal. But also you have to determine where is your stop loss, because the way of trading of a short term, especially intraday, is completely different compared to the swing trade. Because the intraday is that the risk and reward ratio is different. It's different. It's not the same like the swing trade. So you need to be careful, and it's my say need a precision. So when it is precision, you need to anticipate, not the following. You see, you need to anticipate. So when they anticipate, we use the good one is a stochastic, whereby when it's dropped below the level or below the 20 line, or sometimes if it's 1 minute, sometimes it can hit 1 second. If you hit this, you see that it's a hit the almost zero line where it start with the straight line. That is where that we buy. Okay. But remember the sequence first. You see, this is a problem that when I teach people or when I do the coaching or the intraday, they always remember the last thing only. They remember that, oh, when the stochastic hit zero, there is buy. But that is the last thing. The first thing they forgot already. The first thing, the market must be uptrend or it is within the range. Not that simple, but this is, if you understand the theory and then you know how to be good with it, you need to practice. Only then you test it into the market. Not that simple, not that simple.
Okay. Bu Qingpeng would like to ask, can you pick red tone as a case study to determine the direction of the price movement using indicators and oscillators?
First thing is that this is not a buy call. It's just for the education purposes only. Okay, now
Definitely.
Remember that I said what is the first thing first. Okay, first is that first is the, what is it? It is a trend. Okay, the first thing is trend. So now the red tone is a downtrend. Why we say downtrend? Because this is below 20 days moving average. You see, this is 20 days, this daily below 20 days moving. So it is a downtrend. Okay, this is a downtrend. So when downtrend, what are we looking for? We are looking for the trend reversal. See, we are looking for trend reversal. So where we can calculate trend reversal? There are three ways we calculate trend reversal. One is that when the price cross above the 20 days moving average. Not happening yet. Okay, one. Second, is there any divergence here? Okay, divergence here in here. So there is at the moment a stochastic, there's no divergence. Okay, there is no, this is low, higher. No, there's no divergence. Okay, so there's no signal. Okay, third is that there is a crossover here. Yes, but its crossover here is not a confirmed signal. Why? Because the trend is down. Okay, we look at the, is there any turn or is there any reversal? We look at the MACD. The MACD, if we look at this MACD, the histogram, that is still below zero. So, or what we call this orange line is below the green line. Okay? The orange line still below the green line. So we have to wait. The first signal is that when the green line above the orange line, that is the first signal the trend is going to turn. Is it yet? Not yet. Not yet. There is a first signal. There's a first signal. There's possibility of first signal, but there's a first signal or the first indicator is when the green line will cross above this orange line. Okay, now based on this, is going to cross very soon. It's going to cross very soon. But it just tell you, see, the MACD just tell you that the downtrend is over. The uptrend it's not telling you that it's going to have a new trend, it's uptrend, you see, but the trend is over. So which means that once it's crossed, it tell you that, oh, the downtrend is over. It can be sideways, it can be goes down, it can be sideways, it can be go order sideways to 4% or maybe for a couple of days or a couple of weeks, you see, before it will show you its uptrend. So that is how for you to do it. It's how for you to do the analysis. Trend, you see, and also the support and the resistance. Whether you're using what kind of indicators also, usually these are the sequence for you to see. The trend first, and also the support and resistance. But I personally, I always look at the trend, which means that if the stock is downtrend, so I just skip it and find some other stock that is a uptrend. There are 900 over stock, or then 100 over 946 stock in the stock market. So you can find there is a counters that is uptrend. So I'm not going to waste my time just to wait for this kind of what we call a reversal. So I won't wait for this kind of reversal, which means that I always look at the uptrend, because it's easier for us to make money in the uptrend or the uptrend stock compared to waiting for the reversal, because the reversal can be a false signal. Thank you. Okay.
Okay. This Maslan would like to ask, what is orange and green line mean?
Okay, this is MACD. You see, MACD is a formula for the MACD. So if I want to what we call to explain to you the MACD, what is a formula, how to calculate, I will consume a lot of time. So today I just share with you that how to use the MACD. So how to use MACD, the easiest way for you to MACD, that we use these two things. One is that the crossover, which means that the crossover of this line. The second is that the easy one you can see is that the histogram. When histogram is turned green, so which means it shows that is a crossover. It tell you just a crossover. It didn't tell you whether its market is going up or not. Yeah. The most of the indicator, they will tell you that the trend is over. There's always usually the indicator will tell you the trend is over. It's only over. It didn't tell you the starting of a new trend. They tell you that the current trend now, for example, now is that the trend is downtrend or bearish. So one is cross, which means tell you that the bearish is over. So it can be sideways, because usually the cycle of the market is that it's uptrend and then a downtrend, sideways, only then it goes to uptrend.
Okay. There's a question in reference to your last chart on your slide. Yeah. So they would like to ask, what color is for which indicator and what is their significance?
Okay, let's see.
Gonna pull out your slide again.
Okay, let's see. Let me show you the slide again. All right. Okay, this is what I use. See, this is what I use. Because when you do the trading, especially short-term trading, short-term here means not intraday. Short-term here means which means they're talking about the trade about 10 days, 10 to 15 days trade. So I need to see everything in one screen. So I don't have to. Some people they use a multiple screen, but I would prefer to have just one screen. I can see everything. So in this case, so I use this overlay technique. So which means that instead of I put at the bottom or that, so I use overlay. So which means that all of this, the stochastic and also the RSI on the chart or overlay of the chart. Okay, so this is stochastic and MACD. So because I use a lot of MACD and I use a lot of stochastic. Yeah. The red line here is the Bollinger Band. So why we use this? Why we use all this? The first thing is that we want to see is this Bollinger Band is for the Okay, for the this is the purpose for the Bollinger Band. We have to determine volatility. What is the purpose of the volatility? The purpose of the volatility is that to determine whether the trend is strong or not strong. If the market goes up, you see, there's a lot of stock at that market. Yes, currently the market, you can see the price action moving up, but then there is no volatility. So which means that the movement is weak. One of the most weak, which means that it can come down again. So that is why we use volatility. So the next question, how to measure the volatility? Volatility, how to measure or to how to determine what the indicator is to use to determine or to measure the volatility. You can use OBV or overbought volume. You can use moving average of volume or some other things so you can use. But I use the Bollinger Band. It's up to you. You can use anything, but I use Bollinger Band. Okay, one. Second is that to determine the trend. Okay, the trend. This is the trend. Okay, so is the trend up or is trend is down? So we use the MACD to determine the trend. So where is the MACD? MACD is where is the line? The MACD line is this what color is this? It's a magenta. What color is this? It's blue line. This blue line. This is a MACD. So the MACD, you can see, for example, like in here, this is let me see here, for example, here, this is a crossover. This is you see, this is no, not text. Okay, I put it draw. Okay, here. Okay, this is you can see there is a change over what we call the starting of the downtrend. So we know that from starting from here, there's a downtrend already. It's a downtrend, all the way downtrend. Till we come here, this is what we call is an uptrend here. There is a crossover here, and there is a crossover also here. Okay. Now, when there's a crossover here, you have to look at, now we know the trend. Is this uptrend or downtrend? So next question is that where to enter? Which level to enter? There are a lot of ways to enter. Either you can use a reversal, or you can use a reversal or breakout. See? Either reversal or breakout. You can use even the what we call price action when there is a breakout, or you can use the stochastic to confirm the price action. So where is the price action? Okay. This is the price action. Yeah. So when there is a crossover here, which means that it tell you that there is a change of trend. So the question is that is this trend is strong or is just a one-day affair? We look at this stochastic to determine, yes, it is a strong. Why? Because there is a signal of stochastic is given the signal here. So it will show you there is a uptrend. Okay. You understand? Fine. Look at here. This is a signal by the stochastic. See. But is there any signal at the MACD? There's no signal because MACD is going down. So this is a false signal. See? This is a good signal. Why? Because this is a good signal because there is a MACD give you the crossover here. Okay? So that is a good signal, so which means the price is going up. That is not easy if you just yeah, this is basically the basic of the how to do the analysis. Okay. Next question.
All right. So the next question is about Ichimoku. Huh? Okay,
Ichimoku.
it's question by Chu. Heard that Ichimoku is also quite popular among the traders and has some leading indicator and predictive feature. Wondering what is your view and if we should also check it out as well.
Okay, good question. Okay, that's good. Ichimoku. Let's see, we look at Ichimoku. let's say we move this. Okay, this is Ichimoku. Okay, Ichimoku is good also. Is good. Some of the traders, they basically Ichimoku actually is meant for the long-term trade, which means you're talking about long-term trading or for the trend and all that. But then you also can use this Ichimoku for the short term. Okay? But it is it will take a long time to explain how to use the Ichimoku in the short term. Okay? So there's a few lines here because the Ichimoku is good that it incorporate everything inside just a one chart. In this Ichimoku, you can see whether it is the support, the resistance, and the trend, and also the signal. So all of the what you want to know about the market, where to enter, all is incorporated in just one chart. Okay. For example, in here, let's say for the in here. Okay, now the most important in the Ichimoku is the cloud, or we call it Kumo. This Kumo.
I think
cloud.
Tuan, you have to share your. Are you
sorry,
sharing your screen?
Sorry. I thought I shared a screen. Okay. All right. Okay. All right. Yes, this is screen. Okay. Now you can see. Okay. So
Perfect.
the most important for the Ichimoku is the Kumo, or we call it cloud. Say cloud. So it is they have two color, red color or green color. Okay. In this case, the cloud is green color. So which means that it is a bullish, but the bullish is not strong. Why? Because the price action is below the cloud. So when it's strong, the strong is when the price action is above the cloud, only then is a very strong bullish. If it's below the cloud, and then it's a bearish. Yeah. Of course, you need to maybe perhaps we might have some Shane, maybe have some other session on the just purely on Ichimoku alone next year.
Sure. Definitely. We did a intro to Ichimoku early this year, right?
Yes.
Yeah, I think next year we
Ichimoku. Yes.
Go a bit more deeper.
Yes. It's very interesting for using Ichimoku. You can use Ichimoku, but it's more towards a longer term. The shorter term is slightly different on how to use the short term, because a lot of people, they love a short term, but then the way of doing Ichimoku for the shorter term is different, slightly different from the long term. This Ichimoku is very good. They tested it for almost 30 years in Japan by the name of the person Hoshoda. He tested for 30 years. They start to use this Ichimoku since 1944, if I'm not mistaken, and then they introduced it to the public in 1963. And the purpose of the meaning of the Ichimoku Kinkoyu means, which means that at one glance, which means that we are just looking at the Ichimoku alone is enough to tell you all about the market trend, support and resistance, and also signal, buy signal and sell signal. So that is the beauty of the Ichimoku.
In a downtrending market, what are the good indicators to catch the bottom of the share price for? Are RSI and Stochastic a good combination? Are you able to use Alibaba as an example? So this is the question.
He's saying that say again?
In a downtrending market, what are the good indicators to catch the bottom of the share price rebound? Are RSI and Stochastic a good combinations? Are you able to use Baba as an illustration?
Okay, let's see Baba. Alibaba. Okay. Okay, I remove the VPR. This is Alibaba. Okay. First, we have to look at the daily. Okay, so daily is a downtrend because this is downtrend daily.
I think you need to share screen.
Okay, all right, I see. Oh, sorry. Always forgot to share this time.
It's all right.
Okay, all right. This is okay. All right. Now you can see. Now you can see the Alibaba.
Yes.
So this is Alibaba. All right. Okay. First, you have to determine, is it downtrend or uptrend? Okay. As you can see, it is a downtrend. Why? It is below the 20 days moving average. You can see this downtrend. Okay. This is downtrend. Okay. So this daily. If you look at weekly, yes, it's downtrend. And we look at monthly. Why you want to look at monthly? You want to see what are the previous price. Okay. Now you can see that the previous price, so which means that it is now at the level of a support of the support or resistance turn support. This is the highest price previously. That is where around 120. Now is this level. Okay. A lot of traders, or a lot of amateur traders, they try to catch the lowest price. Okay. The problem is that we don't know. We don't know what is the lowest price or when it is the lowest price. We only know when it's the lowest price once it starts to rebound. So for example, just like we take a lift, see, we just close our eyes and we take a lift. How do we know that we have hit the ground floor or the lowest level? Once it starts to move up again, see, or you throw a ball. How do you know that the ball is really hit the floor? One is that is rebound. Only that we know it is hit the floor and then it rebound. It's the same in the stock market, which means that at the moment, is it rebound? No, not yet. Why? There is no indicator or there is no indication is rebound yet. See, so my advice is that, or my style is that I don't forecast, which means I don't forecast. So the question is that now, yes, now it's good. Why? Because now it's a hit the support, or which is now at the level of the support level. Yes, but the support level can be broken. That's the first thing. We can determine or whether it is bottom or not by looking at this stochastic or MSTA. Okay, let's say we go to daily. Okay, now daily. Okay, now this one. From the stochastic and from the MSTA. So we know that the trend is a downtrend. Okay, that's it, downtrend. So the next question, I want to catch the lowest price. Yeah, I want to catch the lowest price. So at the moment, this is the lowest price. Why it is the lowest price? Why? Because that if you notice that this is the lowest previously, and the stochastic also hit the lowest. Now the lowest. Can it go lower? Possible. You see, it's not necessarily. I didn't dare to say that whether this is the lowest price, it will go up. No, but is this lowest price? Yes, it is the lowest price. Why? Because it hit it confluence with the previous low of the stochastic. So this is the lowest price. Can it go lower? The answer is yes. Why? Because there is no indicator or there is no indication that the price are going to move up. So where is the best entry? The best entry is that the first thing, or the first best entry is if the price break above this 135. That is if you are aggressive trader. Okay. If you are aggressive trader, which means that you are willing to take a high risk. If you are not aggressive trader, which means that you are a normal trader, so which means you have to wait for the price to be above the moving average, 20 days moving average, or the trend start to move up or uptrend. One, the price or the indicator give you, or the price action start to move up or start to trending up, only then that we enter the market. Because I don't see the reason. That's all the people why because a lot, if you want to catch the lowest, it is almost something that is almost impossible. Why? Because we don't know. There is no indicator, or there is no indicator or oscillators that can tell you that it will hit the bottom. No. So there's a lot of people that make a mistake. The indicator will tell you only that the trend is over. So based on this stochastic and MACD, you can see that here like this. Based on the stochastic and the MACD here, which means that the trend is still not over, which means that it's still downtrend. That is what we know. But you don't know. Is it going to start a new trend? We don't know. Only that when the price start to move up, only that yes, the trend is over or the downtrend is over, only then it start to move up. So of course, when we talk about limitation, that is the limitation of the technical analysis.
Okay, so thank you, Tuan, for explaining about the charts with your really good examples. So we have gone through a few case studies. We have also gone through many indicators that we have mentioned. So let me just conclude today's sessions by thanking Tuan for doing this webinar segment for us, indicators and oscillators. So thank you everybody for joining in. So let me tell you about our next webinar. So our next webinar is happening on the next Wednesday, that is titled The Art of Drawing Trend Lines. So if those of you who are not familiar with drawing trend lines, or you want to master the art of drawing trend lines, please register for this session that's happening on 8th of December, 8:30 to 10 o'clock. Giving you the link in the chat group. So maybe I have just given you again one more. So this is another session on technical analysis, where we will talk about how do we draw trend lines effectively. So with that, thank you very much to Tuan Haziq Zainal Arifin, who is a principal consultant for MSTA and CFTe program, who come to this session and teach us about how do we use oscillator and indicators. So thank you everybody for joining. Maybe have the great rest of the day. Bye everybody, and have a great weekend as well.
Thank you. Thanks, and
this is Shane signing off.